Welcome to The Pit. I'm Iggy, forensic investor, ranked 8th on Tiger Brokers among Singapore retail investors, and your guide through the SGX market jungle. If you want the full breakdown before the free version drops, Iggy's elite investors get 0-day access, link in the description. Now let's get into today's numbers. The AI algorithm just flagged 6 local momentum stocks promising double-digit yields, completely ignoring that 2 of them carry a combined debt load with an ICR below 3.5 times. If you blindly rotate your retirement funds into these machine-picked tickers, you are walking directly into a mathematical meat grinder. Today, we run these algorithmic darlings through the 5-layer solvency test to expose exactly which balance sheets will destroy your capital.
Looking at this performance screen, it is easy to see why the algorithm gets excited. It looks at a stock chart and sees a sea of green momentum, promising market-beating returns. But the machine has a massive blind spot. In this market environment, the difference between a sanctuary asset and a yield trap is decided before the opening bell, not after the damage is done. The red flags are always there if you know where to look. We are operating in a reality where the cost of debt is the only metric that truly matters. A machine learning model trained on over 50 financial signals to identify stocks most likely to pop completely misses the underlying structural decay. It is pitching you yesterday's growth story while completely ignoring tomorrow's financing wall. And that is exactly how retail investors become exit liquidity. Here on the screener interface, you can see the exact names the AI engine selected. High yield, value, strong profits, momentum. It all sounds like an institutional grade slam dunk to a machine. But we do not buy apologies, and we certainly do not buy based on a headline summary. The market is facing what we call the debt wall. This is a specific date range where companies are forced to refinance their older, cheaper debt at today's much higher, punishing interest rates. An algorithm asks if the price is going up. I look at the exact same company and ask a fundamentally different question. Can this business survive its next refinancing cycle without destroying shareholder equity? That is the only question that matters. To answer that critical question, we rely on the Fortress balance sheet standard, and we start with 2 non-negotiable metrics. First, we demand a gearing ratio strictly below 35%. Gearing measures how much of the company's total assets are funded by debt. Think of it exactly like a mortgage on an investment property. If your mortgage is too high, any drop in your rental income means you lose the property. Second, we demand an interest coverage ratio, or ICR, greater than 4.0 times. The ICR tells us how many times a company's operating profit can pay its current interest bills. Anything below 4.0 times leaves zero margin for error when conditions tighten. When we run the 6 machine-picked names through this standard, the dividend math immediately breaks. Looking at the alert table, you can see the data verified strictly from primary financial statements. Stoneweg Europe Stapled Trust reports a gearing of 42.2%, failing our ceiling entirely, alongside an ICR of just 2.43 times. Digital Core REIT is also severely breaching mandated safety floors, with 37.1% gearing and a 3.37 ICR. The algorithm missed this structural decay entirely, distracted by the shiny yield. Vicom, SBS Transit, Aztec Global, and Franken Group managed to pass the baseline debt tests, but as you will see, surviving the solvency check is only the first step of our audit. That brings us to step 2, the wealth check. Because capital preservation is only half the equation, the other half is ensuring you are actually being compensated for the risk you are taking by holding the equity. A high distribution paired with a declining net asset value is not an investment. It is an engineered illusion. The AI simply divides the trailing payout by the current share price, completely ignoring whether that payout was inflated by a one-off special dividend. We want to see organic net property income driven by actual rent increases. We do not want temporary sponsor top-ups designed to make the yield look attractive for retail buyers just before they raise capital. When we strip away the illusions and calculate the true organic yield, the picture changes completely. We take the asset's core recurring yield and measure it against our absolute minimum hurdle of 4.7%. Stoneweg and Digital Core managed to pass this specific yield test on paper, but remember, they have already failed the solvency check. Vicom offers an organic yield of just 3.5%. SBS Transit drops to 4.45% once special payouts are removed. Aztec Global falls to 3.68%, and Franken Group sits at a miserable 1.35%. Every single one of these 4 names completely fails to meet our baseline standard for taking on equity risk. Let me explain exactly how we arrive at that minimum hurdle, using our stress test buffer. We audit for the storm, not just the sunny day. While the T-bill currently sits around 1.46%, I do not lower my standards to match a temporary market dip. My floor remains at a conservative 3.2%, reflecting the long-term average interest rate standard. To that, we add a mandatory risk premium of 150 basis points. That gives us our 4.7% absolute yield floor. If an asset cannot clear this absolute minimum hurdle organically, it simply does not belong in a retirement portfolio. The most dangerous phrase in retail investing is attractive valuation. When an algorithm flags a stop as cheap, the market has usually already priced in a fundamental deterioration that trailing metrics miss entirely. High yields in this macro environment are rarely a gift. They are almost always an apology for massive impending balance sheet friction. If a business cannot generate enough recurring cash to clear our hurdle organically, I am not interested in their excuses or their one-off payouts. We do not buy apologies in the pit. We buy bulletproof cash flow that lets you sleep at night. Step 3 is the price check, where we look for the forensic gap. This is the explicit difference between the algorithmic fair value and the current market price. A wide gap might look like a screaming buy on a screen, but it often indicates a value trap where the broader market knows something the algorithm does not. I call this the MRT door paradox. Rushing into a cheap momentum stock just because it is heavily discounted is exactly like sprinting for the closing doors of an MRT train. You might make it inside and catch a fast ride, but you also risk getting structurally crushed when the system's safety mechanisms fail to protect you. Looking at the peer comparison table, you see exactly what I mean. Stonewick shows as 28% undervalued, Digital Core 46% undervalued. But if a stock is trading at a massive discount to peers like CapitaLand Ascenders or Mapletree Logistics, while carrying double the debt load, that is not a bargain. That is the market accurately pricing in the risk of a highly dilutive rights issue. The algorithm sees a discount to fair value. Forensic analysis sees a massive red flag. When you compare these names to structurally sound alternatives in the same sectors, the so-called margin of safety evaporates instantly. Machine learning algorithms absolutely love momentum. They are programmed to chase price action and extrapolate quarterly revenue surges into infinity. But capital-intensive businesses on the local SGX exchange do not scale to infinity. They hit physical constraints and financing walls very quickly. When you see a stock surge massively in 12 months, the easy money has already been extracted by institutional players. Buying in now based on a trailing indicator means you are simply providing exit liquidity for the smart money. Never pay a premium for yesterday's growth story when tomorrow's debt bill is due. We must audit the machine's logic against our uncompromising reality. For each of these 6 tickers, the algorithm has presented a bullish thesis based on trailing metrics and momentum. But as we have established, every single one of these stocks failed at least one of our mandatory solvency or yield tests. We will now tear the AI thesis down ticker by ticker using our mandated 5-layer audit, separating the engineered illusions from the actual numbers. First up is Stonewick Europe Stapled Trust. The machine's logic focuses heavily on its near 9% dividend yield and an aggressive fair value target, pointing to gross profit margins. But you cannot pay dividends with gross profit margins. You pay them with free cash flow after servicing debt. Stonewick reports a gross gearing ratio of 42.2%, shattering our strict 35% safety ceiling, alongside a dangerously low ICR of 2.43 times. If European Central Bank rate paths trigger a 10% stress scenario in financing costs, this massive debt load will severely compress their distributable income, stripping approximately 1.5% off the current yield. For a 62-year-old in Topayo relying on this asset for a $50,000 SRS drawdown portfolio, a cut of that magnitude means losing $750 annually. This is a definitive watchlist trigger. Next is Digital Core REIT. The AI is completely enamored with its revenue surge and deep discount to book value. A high yield on top of a fully leased facility sounds great to a machine. But Digital Core carries an aggregate leverage of 37.1% and an ICR of 3.37 times. Both fail our safety minimums. If a macro liquidity crunch causes a negative 10% shift in their data center asset valuations, this gearing load will mechanically spike past 41%, violating debt covenants and forcing a highly dilutive rights issue. For a 55-year-old Heartland investor deploying a $100,000 lump sum CPF rotation, absorbing a sudden capital raise strips away years of compounding. This is an immediate yield trap. Ticker tree is Vicom, selected by the engine for outstanding profitability and a perceived low valuation anchored on EV testing expansion. Vicom actually operates with a flawless net cash balance sheet. Its zero debt structure is mathematically perfect. However, it delivers an organic dividend yield of only 3.5%. This fails our absolute minimum hurdle of 4.7% and lags its own historical average. Even if an influx of EV testing mandates boosts top-line revenue by 10%, the incredibly low base yield means the actual distribution will barely move the needle on your inflation parity. For a retired uncle in Bedok managing a conservative $250,000 dividend portfolio, accepting a 3.5% return means leaving $3,000 on the table every year. We classify this as a strategic neutral asset. Ticker 4 is SBS Transit, flagged by the AI for contract renewals and an eye-watering 12.53% dividend yield. And let's be honest, any double-digit yield on the local exchange is almost certainly an engineered figure. Removing the one-off special dividend reveals a true organic yield of just 4.45%, failing our baseline hurdle. Its underlying cash flow appears heavily reliant on singular capital returns. If changing ridership patterns trigger a 10% compression in fare revenues, this organic yield would drop further toward 3.8%, entirely destroying your risk premium. For a 60-year-old investor in Geelong banking on that double-digit headline number for consistent daily expenses, the inevitable yield normalization means a painful 60% reduction in actual take-home cash. Another classic yield trap. Ticker 5 is Aztec Global. The machine loves the quarterly revenue recovery and another massive headline yield of 14.7%. Aztec holds a pristine net cash position, easily clearing our debt ceilings. But its true organic yield is just 3.68% once special payouts are stripped away, failing our 4.7% baseline. If global semiconductor supply chain bottlenecks trigger a 10% contraction in order books, their operational cash flow would bottleneck, dragging the sustainable yield even lower. For a 58-year-old in Pongo relying on this high beta stock to juice their portfolio, chasing the engineered headline number could wipe out $8,000 in expected annual returns when those special dividends vanish. This is a strict watchlist trigger. If you want to stop getting caught in these engineered yield traps and start building a truly resilient portfolio, Iggy's elite investors get 0-day access to my full institutional-grade watchlist and forensic cheat sheets. Link is in the description. Now let's look at the bottom line. The AI algorithm found 6 stocks that look incredible on a trailing historical basis. But when we apply a forensic solvency and yield audit to these tickers, the machine's narrative fractures completely. By simply stripping away the special dividends and checking the actual debt loads, we expose massive structural weaknesses that the algorithm ignored in favor of price momentum. 0 out of the 6 stocks pass our dual mandate of capital protection and organic yield. So what does this actually mean for you and your wallet? It means that relying on a machine's definition of value without running the actual numbers against the Iggy forensic floor of 3.2% is a surefire way to bleed your hard-earned capital. For a 62-year-old heartland investor in Toa Payoh managing a rigid SRS drawdown schedule, stepping into a 12% yield trap because an AI said it was undervalued is incredibly dangerous. It could mean a permanent impairment of principal when the dividend inevitably normalizes and the unit price collapses. The maximum gearing ceiling of 35% is non-negotiable for a reason. We demand a fortress balance sheet before we even look at the yield. And we demand an organic yield above 4.7% before we even look at the price. These 6 algorithmic movers completely failed those basic tests. They simply do not belong in a capital preservation portfolio. The machine chases the momentum. We protect the capital. If you want to stay ahead of the narrative, remember there is a 7-day embargo on the free public release of these deep dives. Join Iggy's elite investors using the link in the description to get the full forensic breakdown immediately and secure your capital today. This content is produced for educational and informational purposes only. I am not a financial advisor. I am a retail investor who applies forensic analysis to my own portfolio and shares that process publicly. Nothing here constitutes a recommendation to buy, sell, or hold any security, and no specific target prices or personalized financial advice are offered. All data is sourced from public filings and verified sources. Where data is unverified, it is explicitly flagged. All investments carry risk, including the potential loss of principal, and past performance is not indicative of future results. If you are making investment decisions involving CPF, SRS, or personal capital, please conduct your own due diligence or consult a MAS licensed financial advisor before committing funds.